In this video, traders, we are going to look at position sizing best practices. Well worth revisiting some of the basics, especially when the markets are volatile. Stay tuned. Hey guys, very warm welcome to you. Thank you very much for joining me. All right, so hope you're keeping the risk managed, whatever you're trading, whenever you're trading as well, whenever you're watching this. As I'm filming this, we've got extreme volatility. Coronavirus has caused a lot of volatility in the markets, but you know what? Volatility is cyclical. We have all sorts of events that cause volatility, but even if you're not trading in volatile times, you know, it's easier, I think, when it's quieter to kind of get your position sizing right. But sometimes when the volatility shifts right up or contracts right down, there's that extreme move. Very often we can get caught wrong-footed, and it works both ways, guys. You know, I know very often I talk about risk management and you've got to make sure you're not losing more than you want to lose on this kind of stuff. But also on the flip side, if volatility just contracts all of a sudden and you're still trading a position size that's suited to higher volatility, you're just got to not make the money you're used to making. You're not going to be risking enough to make it worthwhile. You know, it's a kind of fine line and a fine balance. Anyway, let's just go back over some of the basic things that are really important to pay attention to when you're looking at risk sizing. So the first thing is the fixed percentage of your current balance risk capital. So what I mean by this, so you probably heard the age-old thing of, hey, you've got to risk 1% or 2% of your balance. Now, those who've been following me for a while know that I don't subscribe to that so much because I think the majority of people don't have that much in their trading account. You know, it's fine if you've got £250,000 in your trading account, 500,000, 300,000, something like that. It makes sense to be able to do that. You want to risk a small amount of money, and fine. If you've got a lesser amount, again, if you're learning, definitely risk even less than that. Risk the smallest amount possible. If you're going through the learning phase, I just think you should be risking the most smallest position size you can do, just to have some skin in the game. That's by the by. You know, assuming now you're trading to make profit, you've kind of gone through the learning curve a little bit, you feel like you've got an edge, you feel like you've got a strategy, that's the whole objective now. You need to dial up that risk a little bit. And sometimes 1%, 2% is not enough for many people's accounts. Now, they'll probably stand out a bit by saying this. Most people say, hey, dial down the risk. But in the real world, guys, sometimes you've got to dial it up a bit. Anyway, this is probably not a discussion for now. I've talked about this before, and something maybe we'll kind of address at another point in time. But let's just use that if you're using 2% rule. You have your fixed percent of your current balance or risk capital, and that's what you're risking per trade. So we'll stick with that for now and say it's 2% per trade. Could be a little bit more in certain conditions, could be a little bit less in certain conditions. Another thing I want to add, guys, is risk capital. Just because you've got money in your account doesn't necessarily mean that's all you're risking. You know, it makes perfect prudent sense. So let's say your risk capital for your trading is, let's just call it £100,000, right? Just figure out the air. Recognize that for a lot of people, that's more than they have in their trading account. Understand that. But imagine it is for this example. You might only want to put 25k in your account. You don't have to have, unless you really need all that leverage for margin for your specific strategies, your trading portfolio strategies, and you need that leverage. You might only put 25k in your account. You might say, well, I'm risking 100k, but why would I have the full 100k in my account? I will just, if I need to add more, I'll add more. But you know, sometimes it doesn't make any sense unless, of course, you need it as leverage for the strategies you're employing. So risk capital or account balance, fixed percentage. You've got that in your mind. Now, the next step is we want to work out the stop loss or exit point based on the trade thesis. Common problem this, and guys, I've fallen into this trap before many times during my learning curve, and probably now and then I fall into it occasionally and just slip up and go, you know what, that wasn't really the best place for a stop, was it? But you know, you're trying to come out of the trade when the thesis of the trade is wrong, is incorrect, is negated. Is there something that comes up and says, hey, that's not applicable anymore? And for most traders, that's going to be a technical basis. A level's breached, a level's touched, a close above a level, close below a level, or something like that. So there's some thesis that is there, no longer valid. That's when you come out of the trade. And that's a lot different, and that's the correct way of doing it, by the way, in my opinion. It's a lot different from saying, okay, I need to have a 50 pip stop. I need to have a 20 pip stop. I need to have and forcing your requirements on the market, because the market doesn't care, guys. We know this. It just does not care where you put your stop or care about you. So you have to have some kind of structure to your trade. And so that's the key point. So once you've got that, you've kind of got your risk capital amount percentage-wise, which you can then convert into a dollar amount. You go, right, I need to use my standard calculation method now. And my standard calculation method is this. For example, say you're risking $1,000 per trade. Probably a lot for most people who are trading or just starting going, I get that. But this is just as an example. Some people might be out there trading, risking 10 grand a trade, 50 grand a trade, whatever. Some people out there risking $10 a trade. It doesn't matter the order of magnitude, guys. You know that. You know this by now. The point is the methodology to doing it. So $1,000 per trade. So what you're doing, let's say, for example, in this kind of little chart pattern, classical bull flag, we're buying it as it breaks the high, got a stop below the flag, pretty textbook stuff. Let's say that risk is 50 pips or 50 ticks or 50 cents, depending on what we're trading. Of course, trading currencies, we've got pips. We're trading, let's say, futures, it's ticks, and if we're trading stocks, it's cents, etc. So that's our risk. Now we can then work out how much size we can put onto the trade. So in this example, if we're risking $1,000 divided by 50, each pip, tick or cent has to be $20 or 20 pounds. I've mixed up pounds and dollars here, but you get the idea. Let's assume that's pounds there. Let's go back and assume that one's pounds there as well. So £1,000 per trade, £1,000 risk divided by 50, you're risking £20 per point move. So if you're trading a spread bet, it'd be very simply £20 per point. If you're trading CFD, 20 CFDs, depending on what CFD you're trading, 2,000 shares, etc., etc. Now you might have to reverse that round if you're trading currencies and do a bit of exchange rate calculation there, but you get the idea. And always one sort of bit of tip, guys, that I do is if you find you're doing something that doesn't quite add up to that, just dial that, or you have to round the position up or down, just always round it down, never go above it, always round it down so that you're getting less than that £1,000 risk per trade. So that means if you get a stop tag, take the 50 pip hit, you're going to lose £20 per point on that, you're going to lose £1,000, and that's exactly what you set out to do. So that's really the simple methodology for doing your position size. And like I say, it could be £100, could be 10,000, doesn't matter, the same things apply. And if that's a wider stop required based on what the market's telling you, again, you reduce your position size. If that happens to be 100 ticks, 100 pips, 100 cents, you're going to reduce your position size to £10 per pip, per point, CFDs, 1,000 shares, that kind of stuff. I think you get the idea. So fixed percentage of your current balance or risk capital. The stop loss is based on the actual trade idea, and in this case, we're using a technical idea for this scenario. And then you're using the standard calculation method of saying, okay, that's the risk, divide it by the risk I'm prepared to take per trade, and then work out my position size from that. All right, guys, whatever you're doing, keep the risk managed. A good, simple way of doing it here. If you've got any other ideas and stuff that little tweaks and adjustments that you make, always interested to hear what you guys got to say in the comment section below. Take care. Bye-bye.